Put your smile on.
Welcome everyone. We're just waiting just a couple of minutes for people to join. Hopefully everybody's having a great day.
And that you're staying warm, because if you're in Texas, it's cold.
Well, it's cold in Texas, isn't it?
Yes, but it is sunny, so that is helpful.
All right, well, we'll get going. Welcome to the Lockheed Martin Retirement Maximization. How not to miss out on what you're entitled to and get every last penny you can get before your retirement countdown clock.
And you know you have one.
Show zero.
Okay, we have some disclaimers for you guys today. Today's webinar is strictly educational for you to learn about your benefits and such. This is not to be taken as tax advice or specific advice for your situation. That can come in a consultation later.
And my name is Josh Strittmatter, and this is Kelly Bufink. We're with Strittmatter Wealth Management Group. We're a registered investment advisor. I've been open since 2007. We are certified financial planners and fiduciaries. We specialize in retirement planning, investment management, estate planning, and real estate investing. And then we've worked with Lockheed employees for many, many years. There's a little bit about us. Kelly, tell them about the course outline.
Today we have a lot to go over, but it's going to be wonderful information. We will start off with just a brief history of what the retirement system used to look like. We'll discuss what a pension looks like now, the advantages, disadvantages of that, things that you should consider before electing those benefits. We'll also give you an entire educational section on how to maximize that pension by using a sample family. We'll talk about your 401k, your retiree health care and what your options are there, all the various portable insurances that you have, and the top 10 mistakes to avoid and how Strittmatter can help you if you want help. So let's get started. Okay. Josh?
Yeah. So a little bit of the history of Lockheed Martin Pension. For those of you who've been there for a long time, you're well aware of this. The pension was frozen back in 2006, which meant no new employees could participate. And then in 2015, the pay component of the pension froze. So no new compensation was taken into consideration. And then in 2019, the service years were frozen. So no more years of service were taken into consideration after 2019. And then lastly, in 2020, they switched to the savings plan where they contributed 6% automatically to all employees.
Yes. And so because all of that was frozen, let's talk about the pension first. So really, let's discuss what a pension is. It is what's called a defined benefit plan, which provides you a specified monthly benefit at retirement if you are eligible. Now, your pension does not have a cost of living adjustment on it for inflation purposes. So when you retire and your pension starts, that's the same amount you're going to get for the rest of your life. Now, in the pension world, there are various ways to calculate that pension. Some companies use a formula based on salary and years of service, like yours, and then others are just based on a specific dollar amount. Yours has that specific formula for years of service and pay, which were the parts that were frozen, and we're going to tell you exactly how that's calculated in just a little bit. Of course, you're eligible for your pension benefits after 5 years of vesting service or at age 65. And with a pension, there are advantages and disadvantages, and there's differences between that and what's called a defined contribution plan. So Josh, why don't you tell them about the differences?
Absolutely. So the defined contribution plan, Kelly, is their 401k plan. And a defined benefit plan is the pension plan. So what are some of the differences between the two? Well, with a 401k plan, Benefits are based solely upon the amounts that are contributed minus any income, expenses, gains, or losses. It also provides an individual account for each person to manage and to monitor. The employees or the employer or both may contribute to the 401k account. Contributions may be based on the percentage of the employee's salary, so through salary deferral. Participants are often responsible for their own investment selection, so you have to choose how you want to invest with your 401k. And then retirement income is usually taxed at ordinary income when withdrawn upon retirement. Now, that's really based upon how you save to the 401k. And then you do have mandatory annual distributions beginning in age 73, unless you were born after 1960, and now it's 75. And then for a pension, the benefits are based on a calculation using years of service, Social Security breakpoint, and then average income, and then an accrual rate. And we'll go through that formula in just a moment. Participants are not required to make contributions to the plan, so the employer, Lockheed, makes contributions to your plan on your behalf. Participants are not responsible for investment selections, so Lockheed has to make the investment selections for you. And the retirement income is usually taxed as ordinary income when withdrawn upon retirement. And indeed, they are fully taxable from a pension. And you do have to begin your pension as late as age 73.
Yes. And both of these have great benefits to them, but let's talk about the benefits of the defined plan. So advantages on that is that the employer, not you, the employer, Lockheed, is responsible for providing you that benefit. You'll know the exact amount of your benefit in retirement. You can request that in advance online. It doesn't depend on your ability to save to it. There's no investment risk to you. The assets behind the scenes on the pension are managed by professional money managers. There's no, it is a tax-deferred savings. And then, of course, some of them, like we said, offer cost of living adjustment. Yours does not, so we don't have to worry about that part. But the pension is insured by the Pension Benefit Guaranteed Corporation, that's the PBGC, meaning if Lockheed ever went out of business, the PBGC would then come in and they would continue to pay a portion of your benefit, but not all of it. Of course, there are some disadvantages too. For a defined benefit plan, there's not an individual account established in your name like a 401k is. And the pension may provide for only a portion of your income that's needed during retirement. Sometimes it can be difficult to understand for the calculation of the pension due to the complex formula. And then it doesn't usually benefit people who leave the company before retirement because pensions are either reduced or there's nothing to take with them if they're not fully vested. And then benefits, of course, are not typically paid out until normal retirement age. And most plans do not allow a lump sum payment in retirement, but rather a monthly income stream, which is what yours is. So let's talk about how it's calculated. Josh?
Absolutely. And by the way, if you have questions as we go along here, folks, you're welcome to type those into the chat and we'll answer them as we go. How are pension benefits calculated? So with every pension, there's a formula, and Lockheed has its own particular formula. It's based on 4 components. The first is the final average pay. The second is the Social Security breakpoint amount. The third is the plan's accrual rate. And the fourth is the credited years of service. So let's break each of those out.
So on the final years of pay, what Lockheed does, they use your highest 3 years during your last 10 years from 2015 backwards to 2005. I almost said 2015 again. But so you take those 3 highest years like the example shows. So in this one, it's 2011, 14, and 15. And they just average those out. So your 3 highest years do not have to be in consecutive order. Maybe you worked in a higher position and you wanted to do something less burdensome, for lack of word. Your pay went down in those later years and then maybe it went back up. So just take those up, divide by 3, and there's your average. And then the Social Security breakpoint.
Yeah, so Social Security breakpoint is based on the maximum wage basis for Social Security. This is published every year. And this year it's around 167, I believe, 167,000. And so what that is that's the amount of money that you pay tax on, or that you pay Social Security tax on. Any amount earned over that amount, you don't pay the Social Security tax on it. And so this changes every year. So this looks at your year of birth and is calculated as an average over a 35-year period, ending with the last day of the year in which you reach your normal retirement age for Social Security. And these are published by the IRS, so you can look this up.
And then the next part, the third part, is your accrual rate. So that's the factor that's applied to your final average pay to determine your benefits. And Lockheed has a tiered calculation formula that they use. So your final average pay up to that Social Security breakpoint you were just talking about, Josh, is 1.25%, so 1.25%, and then it's multiplied by your accredited years of service up to 35 years. Okay, then you add that to the next level, which is the final average pay over that Social Security breakpoint times 1.5%, then multiplied by your credited service up to 35 years. And then there's one more, it's your final average pay times 1.5% of any service years over 35 years. So if you've worked 40 years, those last 5 years get that 1.5 times percent. But let's look at an example.
Yeah, so we've got a person, we'll call him Bill, I think. He wants to look at his pension for 20 years of service, 65-year-old, and he's retiring. And so his final average pay was 125,000. Next, his Social Security breakpoint in that year was 99,720. So he's going to use that. Again, that's based off of his birthday. And he's going to use the factor we talked about, 1.25% multiplied by that Social Security breakpoint of 99,720. That gives you $1,247. Then we're going to look at the amount above the breakpoint, and that's multiplied by 1.5%. So that's 125 minus 99,720 times 1.5, and that's $379. And then we're going to multiply it by the years of credited service through 2019. And so that's 20 years in this example, and that gives you 32,520. So that's the annual amount for the benefit. And then we're going to divide that by 12 to find the monthly amount. Now, what this is the life-only calculation. So the life-only calculation is based off of the pensioner's lifetime with no surviving benefit. So it's the highest payout that you could achieve. So in this case, it's $2,710 for Mr. Bill here.
Yep. And Josh, you mentioned it was the life-only payout. All Lockheed employees have various options on their survivor benefit. The single life is the highest because that pays out over the retiree's lifetime. And if that retiree dies prematurely, then it stops. And if they live 30 years, then it goes for 30 years. But the other options, if you have a spouse or a survivor that you can leave the pension to, well, then you have various options here. You can do 100% survivor, which means your monthly income right after retirement is going to be a little bit lower. And if you die, when you die, your survivor will continue to receive that exact same pension amount for the rest of their life. So that pension continues over 2 lives. That's why the payout is lower. The joint survivor 50% means that the pension amount is lower as well. It's just not as low as the survivor with the 100%, but the survivor now receives 50% of that. So if you got your $4,000 a month pension, survivor gets $2,000 a month. Now there is a pop-up provision. So if you pick either one of these, and your survivor dies before you within the first 5 years of your retirement, then the pension amount pops back up to that single life only. So instead of now only having that $2,000 a month, you have the $4,000 a month. So lots of benefits to choose from and determine which one is right for you.
So, because there are options to choose from, you'll want to choose the right one that's right for you. And then also it's a one-time election. So once you've made the election, you can't change it. So when we're talking about how to choose this selection, you're again considering whether or not you have assets enough that would take you through retirement. If you were going to choose a single life, or if you have a spouse, a single and joint payout, or I should say a life and joint payout. And so you've got to consider how to pay that out. Now, let me tell you about one of the challenges with the joint payout. So first of all, the life only payout challenge is that if I am married and I die in day 2 of that pension, nothing is paid out to a survivor. So that's why you have the joint payouts. And so the joint payout, again, as Kelly was just saying, pays out to my survivor for the rest of their life, a percentage of the amount that I was receiving.
Mm-hmm.
The challenge with that one, though, is it's a lower amount. And so because it's a lower amount, if my survivor dies first, that means that I'll be locked in at that lower level. Now, Lockheed has that 5-year pop-up, which means that that lower amount would pop up to the higher amount, but it's only in the first 5 years. So if your spouse dies in the 6th year, you're stuck at that lower level. And so what pension maximization looks at is using life insurance to remedy that. And Kelly, I'll let you talk about that in the next slide.
Okay. Yeah, let's talk about how that works. Let's use this example of Bob and Julia. It's great to have a real life family to look at when we do this. So Bob's pension offers 2 income choices for him. He can either elect the single life option or the joint and survivor option. And as you can see, the survivor life would pay him $28.75 a month, whereas the joint and survivor only pays $20.10. So that's a difference of $865 per month. Okay, so that difference you don't receive, you are rather paying for the life insurance that guarantees that survivor income. And that insurance is behind the scenes on the Lockheed side of the house. So then oh, go ahead, Josh.
Sure. And so if they choose that single life option and use the extra money to purchase life insurance, they can accomplish the same thing. And so in this case, there's $865 per month left over. So again, that's the single life payout versus the joint payout, the difference between the two. That's $10,380 annually. So the question is can Bob buy an insurance policy, a life insurance policy, that would pay out a lump sum that would pay out $2,010 per month? Again, that's the joint payout, 100% survivor payout, for the remainder of Julia's life. So you've got to calculate how much life insurance that Bob needs based on that 2010 monthly figure. And that is just a present value of an annuity. And so we'll show that to you here.
Well, before we get to more numbers, what we also want to talk about is what happens if Julia dies first? Because if they take the 100% option and she dies in year 6, like you said, the retiree is still left with the lower amount. But if they use Pension Max and they have their own personal insurance, well, now there's control and flexibility. Bob can cancel the policy and take the cash value back out of it. He can keep it and change the beneficiaries. There's all sorts of options that can be used, and you're just not locked into anything. Okay.
Right.
Okay. Now, let me just say there are some other important considerations real quick, and then I'll let you get into the numbers, Josh.
Sure.
When somebody looks at pension maximization, because your Lockheed choice is permanent and you can only make it one time, you've got to make, if you're going to do this and you go the single life only and you're going to use life insurance, you have to make sure the life insurance is in place before you make that decision. Otherwise, you could be jeopardizing yourself. So Bob should actually buy that policy first, make sure it's in force. If he doesn't, and he went to Lockheed and made his choice, then tried to get the life insurance, there might be something that causes him to be uninsurable. There might be a health issue that makes the premium too high, and now he's stuck. So just make sure that we're taking all these into consideration, because you don't want to be up a creek without a paddle. Okay, now I'll let you get into the numbers.
All right. So here is Bob and Julia's numbers for how to calculate how much life insurance they need. So first of all, they're both age 60. They want to retire at age 65. And we're going to assume that Bob's life expectancy is age 89 and Julia's is age 90. So again, the pension amounts are $28.75 for the single payout. And then the joint payout, 100% survivor, is $2,010. So the difference is $865. Now, Lockheed's pension does not inflate. So once you receive it, it stays the same for the rest of your life. And so the lump sum required in the first year of retirement is $322,171. So again, that's the amount that would pay out $2,010 per month for the remainder of Julia's life if Bob died on day one of retirement. Now, something that's unique is that as they get older, the life expectancy need decreases, and that's because they're getting closer to life expectancy. Therefore, less money is needed. And so you can see here in the last year of life, age 89, the only amount of money that's needed is $45,425. So future value of savings is $510,000 at a 6% rate of return, pretty significant. And the break-even age is age 65. So we'll look at this a little bit deeper here. So this chart shows you that lump sum required to replace pension is in column 4. And notice that it starts at that $322,000 and it starts to decrease as they get older. Now, I want you to pay attention to another number on here. It's the year 20. So looking at age 85, it's $121,833. If you can see, I realize that's pretty small, folks, but $121,833 is the lump sum required to replace the pension in year 20. I'm going to come back and talk about that in just a minute, but that's how the lump sum calculation is looked at, and then again, how it decreases over time.
Yes. And then there's a couple ways to put that strategy in place. One is by using cash value or permanent life insurance. So it's permanent because it's designed to actually last your whole entire lifetime until death or upon cancellation. So this is the recommended type because the insurance will not expire prior to your death. A term policy by itself is not usually a good solution because it typically will expire before death. Now, a different third strategy is, of course, using a combination of both that term and permanent insurance because it allows you to pay less overall in premiums than if you were to purchase that cash value policy all by itself.
Yeah, it's a 20-year term life and permanent life. 20-year term expires at the end of 20 years. Permanent life is permanent. So this is whole life, universal life, variable life. These go through the rest of your life. They have two components. One is the insurance, one is the cash value. Therefore, the premium is higher. And so 20-year term is just insurance, so the premium is lower. So you can use a combination of the two. And this is where I was talking about looking at that year 20 value. And so there's my first year, $322,000 in that second bullet point. And then $121,000 is the year 20. The difference between the two is $200,000. So the combo strategy looks at purchasing a 20-year term policy for $200,000 and then a permanent life insurance policy for $121,000. I'm just using round numbers there. And so the reason why you do that is in year 20, the life insurance need is only $121,000. So the 20-year term falls off. What's left is the permanent insurance that would take you through the rest of your life. And that's a strategy to keep your premiums down to make this strategy work for you.
Yeah. So let's now talk about cost of the insurance. Okay. So if we were to do the cash value permanent life only for $322,000, we're looking at about around $3,200 a year, so $266 a month. But if we use the combination, we've got the 20-year term policy of $20,000 that covers from year 1 in retirement to year 20 in retirement for $1,100 a year. And then we have the permanent in place, the $121,000. So that was age 85 down. for 121,000 at 1,300 per year. So add those two together, 1144 plus 1389 gives us 2533 or $211 per month. So annual savings of that combination over the permanent insurance, $31.98 minus the $25.33 is $665 per year of savings that we've used by using a combination. And of course, that gives us a total increase in our pension because we're saving money by buying life insurance. Our pension amount goes up. The difference between the two pension amounts that we saw on the slide before was that $865 a month or $10,380 a year. So that $10,380 a year minus the cost of the combination insurance at $2,533 is $7,847 per year. So we've saved $7,847 per year, roughly giving us that pay raise of $654 per month.
Sweet deal.
Very, very nice. So if you guys have any questions on Pension Max, now would be a great time to ask them before we switch gears and head over to your 401k. I'm just going to watch the chat for just a second before we move on.
Yeah, so just to summarize, folks, this works on a lot of our clients or for a lot of our clients. So if you have a pension, you should do a pension maximization calculation because it can put dollars in your pocket for retirement. And then it gives you, and the other thing I like to talk about, Kelly, with this is that one of the things about a pension is that even if you choose a joint payout, if you both die on day 2 of that, there's nothing that's left to the family. So something that life insurance does for you is provide an inheritance. So not only is it an inheritance, but it's a tax-free inheritance. Life insurance is given to beneficiaries without having to pay income tax on it. So this allows the pension that you've paid into for 30 plus years to actually have some value of inheritance to the next generation, which is valuable.
Yep. Okay, well, let's talk about how we save to offset our pension because if the pension doesn't inflate, we need some extra money. So for the Lockheed 401k, let's talk about the matching here. The company will match you 50% of the first 8% of your contribution. So you want to be contributing at least the 8% so you don't leave any free money on the table, of course. Now in 2025, you're eligible to contribute $23,500. And if you're between the ages of 50 or 59, or you're 64 and older, you can actually put an additional $7,500 in there. Okay, so what about the people who are age 60 to 63? Glad you asked. They have a special catch-up contribution. So they can put in $11,250 more than that $23,500. And it's only that specific age group right there. You have the option to contribute to either pre-tax, which is tax-deferred money, tax-deductible money, or post-tax or Roth portions in your retirement plan. And in the Secure Act in 2.2, they said any Roth catch-up contributions will have to go into the Roth portion of your 401k if your wages are above $145,000. So you'll have to pay attention that if you're still working next year and you're doing catch-up contributions, because it will start January 1st of 2026. So, okay, here's a graph on what that 50% looks like. If you do 8%, they give you 4. If you do 6%, they give you 3. If you do 4, they give you 2, and so forth. Easy math. Okay, but Josh, Lockheed is special on their 401k. And how much
They sure are.
So tell them about how they contribute more than the IRS maximum.
Absolutely. So Lockheed has a special rule that allows you to save more money than what you would normally contribute to a 401k. And that's you can contribute up to 40% of your base salary up to the IRS limit. And so it's 100% of compensation or $70,000. Or if you're over the age of 50, $77,500 or $81,250, including the catch-up contributions, and that's in 2025. What that means, folks, is that you can put more money in your 401k than just the IRS limit of $31,000K. Huge benefit I've yet to see another company that allows for that. So that's a really big deal.
Mhm. And the fact that you have post-tax, pre-tax, and Roth contributions means you have various ways to transfer those dollars when you retire, to invest them somewhere else where you have more opportunity. So for your post-tax contributions, those can roll directly to a Roth IRA once you reach 59 and a half or you retire. So if you are still working and you are over 59 and a half, you can do what's called an in-service withdrawal, roll it out of your 401k into a Roth IRA and open up your investment world even further. Now, when you roll your account, you actually receive two checks. One check is for any pre-tax dollars, and the second check is for any post-tax dollars. So your pre-tax dollars are tax deferred. Those go into a traditional IRA, and they stay tax deferred. And they go directly from Empower to your new custodian. That way, there's no tax penalty for you. The post-tax check would be deposited into a Roth IRA. That way, it all grows tax-free. You want to make sure you don't accidentally mix these up and put post-tax dollars in the pre-tax bucket, because then you're paying taxes again. Okay? So we definitely want to keep the tax benefits the same.
Yeah. And, something else a lot of people don't think about is that a 401k is a direct transfer asset. And so what that means is that if you name a beneficiary for your 401k, that will bypass probate. It does not get probated. All the beneficiary has to provide is a death certificate, and then they have immediate access and they're the immediate owner of that account. I've seen many times, folks, where people don't name a beneficiary in their 401k, and then they have to go probate that 401k. So what does that mean? You got to hire an attorney in many cases, and then you got to go to court. So the easy way to avoid that is to make sure you have a beneficiary, and then also to have a contingent beneficiary. So you have a primary, the person who would inherit at your death, and the contingent would be the one that would inherit if the primary predeceased you. So always good to have a primary and contingent beneficiary on your 401ks.
Yes, and make sure you review those, even if you think you already have one on there. Sometimes it's not the person you thought it should be currently, so you'll need to update that. Okay, let's talk about your company stock. So if you're like most Lockheed employees, then you probably own some Lockheed Martin stock in your 401k. Okay, some are heavily weighted in it and some have a little bit. So there's a strategy called the net unrealized appreciation that can help you transfer your stock out of your 401k into a non-qualified taxable account, basically a brokerage account that is not an IRA. Okay, it allows you to pay the tax on the transfer at long-term capital gains rates rather than your ordinary income rates. That can actually potentially save you quite a bit of money depending on your tax bracket. Now, this isn't something for everybody. So you want to make sure you talk to your tax advisor and your financial planner before you actually make the decision to do it, and do the calculation and really see if it's something that's right for you. Anything you want to add on that, Josh?
Just to clarify, the basis part, you pay ordinary income tax on it. And then any gains, you pay the long-term capital gains on it. So for a lot of people who've had Lockheed stock for many years, who have a lot of gains, that means that those gains get taxed at a lower rate. And that's the true benefit of it. The disadvantage is that you got to pay tax when you transfer it out of the 401k, because it has to go into a brokerage account. And so taxes would be due on the principal amount when you take it out. And so sometimes that can be a big tax bill. So this just requires planning and making sure it's a good fit for you.
Absolutely. Okay, we're going to switch gears again because now it's time to talk about everyone's favorite thing, and that's medical insurance. Woohoo!
Woohoo.
No, well, Lockheed actually has some really great medical insurance plans that some employees may be eligible for after they retire. The enrollment can begin either at retirement or when the pension benefit begins. And because the coverage may be different in retirement than what you have while you're employed, you definitely want to talk to the service center, and their phone number's on the screen in case you need it. because they'll be the ones to give you a little bit more details in that, and they can give you the quotes for what the coverage will be. Okay. Also, when you're in retirement and you are using Lockheed's supplemental insurance, Lockheed also has a subsidy that they will pay the retiree and their spouse to help offset some of the costs. So, Josh, why don't you tell them about Medicare supplements, since we just talked about supplements and subsidies?
Yeah, another cool benefit for retirees of Lockheed is that they have a Medicare supplement advantage plan through via benefits. So you become eligible for Medicare at age 65. And so that's when this plan kicks into place. And the benefit of this is that they provide a subsidy to these plans. So you actually get it at a reduced cost through their HRA, their health reimbursement arrangement. You do have to enroll in both Part A and Part B, and you must enroll through the VIA benefits or have TRICARE for life to be eligible for the subsidy. So just be sure and plan that, folks, because you can be not allowed to be able to use this if you don't do it correctly. You may enroll later and still be eligible for the subsidy, but it depends upon your situation. So again, just requires a little bit of planning.
The other part on insurance is while you are actively working, there is a health savings account that might be available for you if you have the high deductible health insurance plan. So an HSA is an account where you can save pre-tax dollars. So they're tax deductible dollars that can be used at a later date to pay for qualified medical expenses and medications. So the IRS doesn't have contribution. They do have contribution limits on the account. They're on the screen. So for 2025, they went up a little bit. If it's a single plan, it's $4,300 for the year. And if it's a family plan, it's $8,550 for the year. And if you are over age 55, you can put an extra $1,000 into that catch-up contribution. So what's really great about this account is that when the dollars are used for those qualified medical purposes, then there's no tax on the distribution. So you got the deduction putting money in, it grew tax deferred because you can put it in a savings, you can invest it. So any growth is tax deferred. And then when you spend it on qualified items, it's tax free. So those are great ideas for sure.
Yeah, and there's additional benefits on those too. What's unique about the HSA through Lockheed, Kelly, is that not only do you not pay income tax on the amount that you're saving, but you also don't pay FICA taxes. So when you do it through your employer, you don't pay FICA taxes on the contribution, and that's 7.65% of your pay. So if you're in the 22% tax bracket, and then you have 7.65% FICA tax, that's 29.65% rate of return on that money that you put aside because you're not paying the tax on that money. And keep in mind is that this has to be used for medical for it to be tax-free though. So if you use it for something other than medical, you get penalized 10%. However, once you reach age 65, that penalty goes away. So you can use it for other types of expenses. You will pay tax on the earnings. You just won't pay tax. You won't pay the penalty. And then also remember, folks, is once you enroll in Medicare, you're no longer eligible for the HSA. So, and the HSA is prorated. It looks at the year, the amount of time that you've been in the HSA for the year. So you have to make a prorated amount depending on when you start your Medicare. So just some things to consider for you, but a great way to save to a place where you never pay tax on the money. It's one of the few places that you don't pay tax.
Yep. Great option. Great option. There's some other really good insurances that are in place at Lockheed. If you are an employee, you have the option to enroll in term life insurance. They have the additional group universal life insurance where you can get higher multiples of your salary. If you're somebody who travels a lot for work, you can do the special accident insurance. You can put insurance on your dependents, spouse, and children if necessary. The supplemental medical, you can have long-term disability, you can have long-term care. Now, if you have these in place when you go to retire, you can actually take them with you into retirement, typically without any underwriting. So it doesn't matter what your health status is. Of course, if you don't have these all in place and you want them, then you might have to prove your insurability. So let's say you have 200,000 of group universal life, but you want to do that pension max and you need a little bit more. I'd get it during open season. That way you have it when you retire. But if you don't have it, you can apply for it. You just have to answer the medical questions to make sure that you are insurable the way that they want. Yeah. Okay. Well, I know we're getting towards the end, so let's talk about the top 10 retirement mistakes that you don't want to make.
All right. So number one, not taking advantage of the full 401k match of 50% of 8% and getting your free money.
Yes. And the second one is not taking vacation, then retiring. Josh, did you know the number of Lockheed employees that have hours and hours and hours of PTO, and they could use that, get their same salary, and then slowly phase out and retire? That's a great idea.
Yep, it's a great plan. Number three, not using the pension maximization strategy. Again, we've shown where you can get a few $1,000s in your retirement per year by using this strategy.
Yep. And number four, not using the post-tax portion of the 401k to save more money.
Yeah, so that's that 40% additional amount that you can put into your 401k that we talked about. Number five, not rolling post-tax portion of your 401k over into your Roth IRA. So remember, any post-tax amount that doesn't go into the Roth 401k can go into a Roth IRA when you roll it out.
Number six, not naming a beneficiary on your 401k.
Very important. Number seven, not taking advantage of net unrealized appreciation for Lockheed stock. Again, another tax strategy that can help save you thousands of dollars in taxes.
And eight, not utilizing your Lockheed Healthcare and Medicare benefit that can also help you and get that subsidy to help pay for it.
Number nine, not contributing the maximum to your health savings account and therefore getting that tax-free benefit for medical costs in retirement.
And number 10, not utilizing the guaranteed life insurance portion of your insurance benefits.
And the bonus, Kelly, not using Strittmatter Wealth to plan your retirement.
Oh, Josh, we help hundreds of families. Man, between the two of us, we have over 40 years of experience. I can't even think about how many wonderful differences we've made in people's lives.
Absolutely.
So, what does everybody need to do next?
Well, they should begin to gather their information. So we recommend writing down your objectives and questions based on what you've learned in this class, and then take action. So you've learned a lot of stuff today. Take action on the information to create a plan for yourself to implement these ideas. If we can help you, you can request a complimentary consultation, begin your retirement planning, and see if the PIN Max strategy will work for you.
Yep. And we offer more than just the complimentary consultation and PIMMAX analysis. For our clients, we do comprehensive planning. So looking at all areas of retirement, estate, tax planning. We have 3 certified financial planners here and licensed advisors as well. And we charge a flat fee when somebody works with us.
Yep. And we're an independent RIA, registered investment advisor. So we have no affiliations with any investment companies, no proprietary products, and therefore no conflicts of interest.
We also have our own insurance agency. That way, if we need to fill a gap, help somebody put insurance in place, whether it's long-term care, life insurance, disability, we can put that in place for them. And then as a separate bonus that's not listed on here, because we are truly comprehensive, Josh, a lot of our clients own real estate or they want to get into real estate. So we have a real estate management company where we can manage that for them too, help them buy and sell properties, even buy and sell businesses on the brokerage side. So
Absolutely.
we are comprehensive.
Yep. And if you want to learn more, you can request our complimentary discovery meeting. I'll tell you more about that in just a minute. Just very quickly, though, we want to thank you. We have a Lockheed Martin blog that you can sign up for on our website. If you can go to strittmatterwealth.com, you'll see the blog there. We have some fantastic newsletters that you can sign up for. If you've enjoyed this webinar, we have popular classes. We're in Fort Worth, Texas, so our classes are taught at local colleges here, and you go to strittmatterwealth.com to see when we teach. We're also on Facebook, so we'd love for you to like us on Facebook. You'll get all future event notifications on Facebook. And then lastly, all of you, because you have attended today's webinar, are eligible to receive one of two complimentary analysis. The first one is the 401k analysis report. This is where we review your existing portfolios for ways to improve your performance, review your investment risk to minimize unnecessary losses. We'll give you personal recommendations on how to invest to maximize your growth over time. We value this report at $500, and we offer this complimentary today. If you sign up for this today by 5 p.m., and I'll have a QR code for you in just a moment, but we also have a second report, Kelly.
Yeah, that one is for the pension maximization analysis to see where should you be and which strategy is right for you. We'll determine the amount and the cost of insurance needed. We can put a place and plan that will help you get the most out of your pension, show you which route works best for you. That one is also standalone at $500 and also has a limited time offer of signing up today. So out of those two options, you get to pick one. And here's the QR code you were talking about, Josh.
Absolutely. So if you're interested in that offer, folks, just click on that QR code with your phone. If you don't know how to do that, the web address is just below it. So if you'll type that into your browser address bar, that will come up for you just the same. So on there, it'll have both of those options, and you can choose which one you like. Now, these generally fill up quickly, so you want to try to schedule pretty quick because our meeting time slots. This is a discovery meeting. So we'll have a meeting with you to get the information that we need to prepare the report. Then we take that information and we prepare that report and have a second meeting where we present it to you. That's either online or in person, depending on where you live. We'd love to see you in person if we can. But yep, that's an hour meeting. And when you go to schedule that, there will be time slots available for both Kelly and I to help you with that. And again, those time slots fill up pretty quickly. So you want to do it as soon as you can if you're interested in this offer. Folks, this is a way for us to introduce ourselves to you, show you some value, and so show you what we can do for you, and then help you to retire and do the things that you want to do in life. So we hope we can help you. Other than that, we're going to take questions now. So we'll leave this QR code up on the screen, but we'll take the next couple of minutes to take any questions. We hope you've enjoyed today's presentation. By the way, you're going to get sent copies of this webinar. You are welcome to forward it on to anybody that you know that you think could benefit from it. And we're happy to help them as well. So thank you again, and we'll stick around for any questions that you do have.
Okay. Josh, here's a question. It says, what if I am still working at age 65? Do I have to do anything with Medicare and VIA benefits? The answer to that is no. If you are still fully employed and covered under your group health insurance, you don't have to do anything with Medicare yet, but when you retire, you will. You'll want to start shopping around and talking to your VIA benefits supplemental care person about 3 months ahead of time to make sure you don't have any gap in coverage.
Yep, that's right. And another question, Kelly, what exactly does the report entail for the 401k analysis? So what we do is we look at all of the 401k investments that you've invested into, and then we look at all the different options, and we'll talk about your risk tolerance. We'll talk about your time horizon for when you need the money, so when you're going to retire, and then give you some recommendations on how to allocate that money appropriately for yourself. And so this is especially important as you get closer to retirement to be allocated correctly. Right now, we're kind of at some really peak markets. So depending on where you're at in your stage of planning, now might be a time to do a reallocation change to your 401k based on getting close to retirement. So again, that's a report where we'll just analyze your funds and give you some recommendations.
Yeah, here's another one. I'm over 59 and a half. I'm interested in moving money out. How does that work? Well, if you're working with us, the way it works is we make sure you have the correct account set up to receive that money in the same tax deferred or tax-free way. And then our operations specialist calls Empower with you. Now, if you're still actively employed, sometimes you can't roll the whole thing out, but they'll tell us on the phone how much is eligible to be rolled out. And then they'll send you the checks, you send us the checks, we deposit into your account and invest your dollars according to what your needs are. There would have been a recommendation for you on how those dollars would be invested. Great questions today.
Absolutely. Another question, Kelly, how do you guys charge? So we charge a flat fee for financial planning. Of course, this report is this discovery meeting that we offer you here is complimentary, but for comprehensive planning, we charge a flat fee, and that's based on complexity. And then for investments, we charge a flat percentage. That's based on the total amount that you invest with us. And when we sit down with you, we'll quote you your fees to you then, and then you can make a decision as to whether or not it would be valuable to you.
Absolutely. If you have any other questions, go ahead and type them in. We'll wait another minute or so.
All right. Well, guys, and if you do have questions, you're welcome to shoot us an email as well. Otherwise, we look forward to seeing you again soon. Thank you very much.
Thank you. Bye-bye.
Bye-bye.